Welcome to chapter 14, excuse me, chapter 15 on stockholders' equity. Let me go ahead and share the PowerPoint here, and we'll go through the most important aspects of the PowerPoint. Okay, so our learning goals here are, we're going to describe stockholders' equity, the main components, three main components. How do we issue common stock? The costs associated with that, stock issuance costs, kind of like bond issue costs we learned in chapter 14. What do we do on stock splits? Treasury stock, corporate buybacks, very important. And preferred stock as well, another type of stock in addition to common stock. What do we do with retained earnings, prior period adjustments, and dividends? And then we're going to look at the section called Other Comprehensive Income, which is going to come up when we look into chapter 16 as well on investments, what we do with gains and losses. Of course, there's disclosures on all of this. The main components, stockholders' equity, really is a combination of retained earnings, which is the link between your income statement and your balance sheet. Also your contributed capital, your other comprehensive income. But many times companies that are nonprofits, they don't have a stockholders' equity. They have what's called net assets, which is the excess of assets over liabilities, right? Assets minus liabilities. So it's not always called stockholders' equity, which gives you the particular mindset that, well, all companies have retained earnings or all companies have equity. They don't. You could have net assets. So the first part, or first one of the three components of stockholders' equity is contributed capital. Contributed capital as common shareholders and preferred shareholders. I have highlighted in red there that preferred stock acts like debt, and it does in a lot of ways, but it's always classified as equity. But it acts like debt because it's usually stated as a dividend, or it's dividend bearing, and it's usually stated as a percentage as far as what the dividends are that are paid out. Unlike debt, preferred stock that is sold doesn't have to be paid back to an individual that invests in your company. It is stock. Typically doesn't go up in capital value like common stock does. Preferred, again, acts like debt even though it is equity. So we normally make those transactions with a debit to cash, right? And we credit common stock at par and credit the remainder of that, or the plug number, as additional paid-in capital. The two other components of a stockholder's equity is retained earnings. As you close out your revenues and expenses to zero, to income summary. Income summary is closed out to retained earnings as either a debit or a credit. Debit if it's a loss, credit if it's a net income for the year or period. And then we have this section called Accumulated Other Comprehensive Income, OCI. And as it states here, these unrealized gains and losses from these investments. And we're going to go into that in detail in chapter 16 on investments. Very important. So there's a good little graph that shows you, or chart that shows you contributed capital, retained earnings, and OCI. Now each of those fit in to the overall equity view. All right, so how do we issue stock? Well, first of all, we have really three areas, like a bullseye. Authorized shares, which is really the very large bullseye. That's what a firm can legally issue. Issued shares, in other words, for shares that have been sold, is always a smaller circle within the larger circle of authorized. So the smaller circle is issued, and then the very small unissued, authorized but not issued, is the difference between issued and outstanding. And they don't show us, there it is, outstanding shares. That's the middle, that's the bullseye, which is smaller than the issued, and the issued is smaller than the authorized. Well, what's the difference between the issued and the outstanding? Well, that's treasury stocks, because when a company buys back its stock, these corporate buybacks, what's been issued is reduced by the number of buybacks that's outstanding, because outstanding is what is used as the denominator for earnings per share. You don't pay dividends on corporate buybacks, but we'll look at that here shortly. All right, so authorized, issued, and outstanding. And in this particular example for Redgo, you can see the 58,000 issued shares, that's 16,000 treasury. There's 17,000 shares unissued, the 75,000 authorized. So authorized, issued, shares in treasury, so 58 minus 16 says we've got 42,000 shares that we calculate earnings per share on. All right, a simple transaction here that we sell stock for $4,000. Par value, which is just a arbitrary number. The par value is $1 per share. You rarely find no par stock, but it's usually $1 or less per share is the par value. So par we calculate, and then the additional paid-in capital is the plug number, as we like to say. All right, what about stock issue costs? You know, we looked in the last chapter, chapter 14, about bond issue costs. What about stock issue costs? Well, bond issue costs used to be an asset, now it's a contra liability account, has a debit balance. These stock issue costs, we're just going to take that straight out of our cash, and it's going to come out of additional paid-in capital. So there is no account associated with these stock issue costs that's amortized, unlike what we do with bonds. So that is a difference. All right, and so this example here, the stock issue cost, to modify that previous example, we take those $200 out of the $4,000, leaves us $3,800. And we take that out of additional paid-in capital. No separate account for stock issue cost. Sometimes you grant stock to someone or a company that maybe they do work for you, but there's no cash exchanges hands. Maybe it's in lieu of a bill. In that case, fair value of the consideration given is what is used. What if the stock doesn't have reliable fair value? Meaning, what if the stock is not actively traded, as I've stated here in caps and bold? In that case, you want to use the most reliable fair value that you do have, which is the exchange for the fair value of the consideration given. And so here, this company has issued common stock for legal services, and they think this has a fair value of $2,000. So that $2,000 is going to be expensed, and and the common stock is going to be debited at, or excuse me, credited for par value, and the difference goes to additional paid-in capital, because that is the fair value of what's been given. All right, what are stock splits? Stock splits, that has no impact on your financial statements other than changing the par value. But stock splits, whenever a company decides that their stock has reached a value that they want to lower that. If you look back on Netflix as an example, Netflix had a 7-for-1 stock split several years ago because the stock price had gotten up to around $700 per share. Well, not everybody can buy a $700 share of stock, is the thought, but maybe they can buy a $100 share. Of course, your large investment houses, it doesn't make any difference. But also the optics of seeing a stock split tends to make people think, well, if the stock split, it's because it's gone up in value significantly, and it's going to just keep going up in value. So it's sort of a marketing technique as well. But for us as accountants, we don't have to make a journal entry. We just have to change the par value. So when a company splits their stock, like Netflix did, 7-for-1, at 4 o'clock when the market closes and the stock is selling for $700, at 9:30 a.m. the next day, when the market opens, that stock's going to be selling for $100 a share. Because if I had 1 share the day before at $700, now I have 7 shares that in the marketplace are worth $100 a share. All right, and they go through that there as an example. You can read that on your own. All right, what about treasury stock, including repurchases and reissuance under the cost method and the retirement? You know, companies buy back their shares. It's usually called a corporate buyback. Corporate buyback. That's the common term, not treasury shares. Companies will do this for their stock option plans, and we'll get into stock options here. We'll get into stock options here later on in a later chapter. A lot of stuff going on my computer here that's distracting me. But companies buy back their stock. You know, like I said, when you buy back your stock, that takes those shares off the market. You no longer have to pay dividends on those shares that a company owns that has bought their own company shares back. It's an investment. If they think their stock is undervalued, it's going to keep going. It's an investment, although it's not an asset. It's just a contra equity account. That's what treasury stock is. Treasury stock has a normal debit balance, even though it's an equity account. Maybe it boosts the price of the stock, because if I have fewer shares out there, then my earnings per share is going to go up for no other reason than my denominator has gone down, because outstanding shares has gone down by this corporate purchases of my stock. Maybe you're trying to prevent takeover attempts. A lot of reasons to do that. Again, it's a contra stockholders equity account. Reduce the number of shares outstanding. There's no voting rights associated with that, and you don't pay dividends on it. A lot of reasons companies do this. All right, once we purchase our stock through acquisition, we debit treasury stock, credit cash, because I have to pay cash. If I'm a company, I have to pay cash to buy my own stock back. It is an investment, although it's not an asset. It is a contra equity account. But what happens if I take that stock and then resell it, meaning I reissue? What's above cost, meaning I've got a gain, right? It's going to be a credit to additional paid-in capital treasury stock. If it's a loss, then I'm going to reduce that additional paid-in capital if there's any dollars in that additional paid-in capital treasury stock, because that's a separate account from additional paid-in capital common. Additional paid-in capital treasury, if I've got previous gains and I take those gains to zero, then I take the rest of that out of retained earnings. If I buy all of these shares of stock and then I turn around and sell them all at a loss, then I'll have to reduce retained earnings. You never have a debit balance in additional paid-in capital treasury stock. So here's a good example. They buy back $1,000. Three months later, the shareholder buys the same shares back at $1,100. What are the entries? All right, so I invest $1,000 in my stock, and then when I sell it, I'm going to make $100 a share, or excuse me, $100 total. There's $1,100 cash from reselling my stock. There's the treasury stock, has to be zeroed out. Treasury stock is zero now. And then the gain goes to additional paid-in capital from treasury stock transactions. It doesn't go to your income statement. It stays on your balance sheet in equity. Even though it's an investment, you got a gain, it doesn't go to the balance sheet. If you take in your cash and invest in any other company, it's going to be an asset called an investment, whether it's in bonds or in stock. If you have gains or losses there, yes, there's different considerations to different things to consider there, as far as in some cases it stays on your balance sheet as a holding gain or loss, but in other cases it goes straight to the income statement. But we'll talk about that in chapter 16. All right, here it says that they sold these same shares back at $800. So in that case, we have a loss, don't we? And so since we have a loss, then I have to take it straight out of retained earnings. You never debit additional paid-in capital treasury stock unless it has a credit balance. Remember that. And here's an outline for that process if you'd like to read that. Here's a case where it looks like they sell for multiple, the stock that they buy back, they sell it multiple times. There's the original $200,000 investment in their own company stock. Then they sell back 2,000 shares for $130,000. And again, that's a gain of $50,000 additional paid-in capital, right? $50,000. Then they sell the rest of it at a loss. Well, I can only take that additional paid in capital treasury stock down to zero. So the remainder of that comes out of retained earnings. You can make debit entries on retained earnings, even from the beginning when it has a zero balance. Because if you're a company that starts up and you start losing money, you're going to have a debit balance in retained earnings. The treasury stock always has to come out in how it went in at cost. It goes in at cost, it has to come out of the treasury stock account at cost. All right. About preferred stock. You know, common stock is ownership, voting rights, and so forth. Preferred stock has preference over dividends. If a company is able to pay dividends and they actually have dividends, not every company does. Your Googles, your Facebooks, your Netflixes, they're not going to have dividends because they pump all their cash right back into their business model. People are fine with that. When your stock's going up that much, they don't, who cares about a 2 or 3% dividend? They don't. But if you are a company that has both common and preferred stock, then those preferred stock holders are going to be paid their dividends first. That's why it's called preference. It's usually non-voting. And if there's a liquidation, it's going to have claim to the assets before the common shareholders. And of course, the debt holders don't have preference even before that, before the ownership. Preferred stock versus debt financing. Preferred stock taxation disadvantage. Why is that? Preferred dividends are paid after a company pays taxes, right? You remember the 20/20 equation of earnings per share, net income minus preferred dividends divided by common shares outstanding. You always subtract out those preferred dividends, which is an after-tax deduction. If it's interest expense, which is from bonds or notes payable, that is pre-tax. That is interest expense. That is deducted before you pay income tax. So that's why it says preferred shares have a taxation disadvantage. Also, private equity capital, raise private equity capital without giving up control of the corporation, because you're not giving up control. You're not giving up any ownership with preferred stock. Preferred stock is not ownership. Common stock is the ownership. That's why common stock is always used to calculate earnings per share. That's why if you look at return on stockholders' equity, again, net income minus preferred dividends divided by average common shareholders dollars outstanding, average common shareholders dollars, that has preferred carved out of that as well. All right, there's 4 different features of preferred. There's cumulative, meaning that if a company is unable to pay dividends, those dividends are cumulative. That means they're going to accumulate. If you get into arrears, it's going to accumulate until a company is able to pay that. Participating means not only are preferred dividends paid out to a company, but then common shareholders, as they are paid out after preferred dividends, if it's participating, then the preferred holders are also going to participate with the common shareholders in the second distribution. Convertible is like convertible bonds. Preferred shares may be convertible into common shares if they're stated as such. And then the other one is callable, just like callable bonds. If interest rates are going down, do you want to keep paying a high dividend rate or a high interest rate? And the answer is no, you don't. So if you can call that preferred in, of course, company's going to have to fork over the money for that to buy those, and then stop paying the dividends or stop paying the high rate of interest. And that's pretty much what I just covered there. All right, so here we have cumulative preferred shares. How do we record that? There's my cash I received. There's preferred stock, and you can see how preferred stock, 6%, it shows you exactly the percentage that you're going to pay in dividends. So 6% of 100,000 is the stated dividend. Not 6% of 130,000, 6% of the par value, which is 100,000. So they're going to be paying out $6,000 per year if they are able to. If they were able to pay it. If it's bonds, you would have to pay that. It's an obligation, right? So here's an example that they actually are in arrears. They weren't able to pay that, but since it's stated, this preferred stock is stated as being cumulative, then when we get to 2016, they owe $30,000 for when they are able to pay that. All right, and so there's dividends preferred is my debit. This is a new way of doing it. In the old days, dividends preferred there, that debit is actually retained earnings. So dividends preferred is a equity account. Dividends preferred is the same thing as debiting retained earnings. And then the credit is dividends payable. That is a liability, right? But in the old days, you would debit retained earnings, credit dividends payable. And then once those dividends are paid, dividends payable is zeroed out and it comes out of cash. Participating preferred shares means you're participating also with common shareholders. Convertible preferred shares can be converted over into common shares. Here's where a company sold $100,000 of preferred stock. There's your $70,000 at par and $30,000 additional paid in capital. If that's convertible into common stock, you got to clean your books up. So the $70,000 and $30,000 has got to be zeroed out off your books. The next entry is common stock at par, however many shares that was converted to. My plug number is the 99,000. Additional paid in capital in excess of par common. Just like if I sold this common stock to begin with, or issued this common stock to begin with. Callable preferred shares, if it's in arrears, meaning I haven't been able to pay my dividends, I've got to catch that up before I call that in. And again, why do you have preferred stock potentially callable if interest rates have declined? Why keep paying a high dividend rate if you don't have to? To make your stock price go up, the fact that you're paying a high dividend. All right, there's a comparison of GAAP versus IFRS. I don't typically test on IFRS in this class since it's intermediate level, but it doesn't hurt to see the difference. I'm not sure how much the CPA exam focuses on IFRS now. I talked to a student a couple of years ago and said, I think there was 2 questions on the section that she took in the exam, if it was reg or what, I don't remember which section it was, but 2 questions out of how many? That wasn't much on IFRS. Of course, that may be different when you take it. Who knows? All right, accounting for retained earnings, including dividends, prior period adjustments. So what impacts retained earnings? Well, you got net income. Dividends have to come out of retained earnings. I mean, in order to pay dividends, you have to have 2 things. You have to have cash dividends. You have to have retained earnings, and you have to have cash. Sale of treasury stock below cost, we saw that. If we actually have a loss on our treasury stock from where we sell it for less than cost, that goes against retained earnings. Prior period adjustment. So those are the 4 areas that impact retained earnings. 4 types of dividends: cash dividends and stock dividends, property dividends, liquidating dividends. Those are the ones we primarily focus on, or cash and stock dividends are the 2 that we focus on in intermediate. You may have some liquidating dividends, which has to do with if you work for a company that's heavily involved in natural resources. But cash dividends, pretty straightforward what we do there. Stock dividends as well is not too complicated. I cover both of those in 2020. So this isn't really any more complicated than what you would have in principles. There's 4 dates. I know in principles we talk about 3 dates that are important for cash dividends. The date of declaration, which that's the legal liability when the board of directors declares a dividend. That's when you make your journal entry. Debit retained earnings, credit dividends payable. Nothing happens on the record date or ex-dividend date except those 2, which were combined in principles. 2 and 3 were combined in principles. That's the date of record that you have to decide who is going to get the dividend and who is not. And then the payment date is when you reverse the entry you made in number 1. So number 4 there is going to be a debit to dividends payable and a credit to cash. All right, there's a good example of comparing the timeline of a data declaration, ex-dividend date, data record, and payment date. Kind of help you see what happens on that ex-dividend date and data record. But there's our $3,000 dividends common debit and a credit to dividends payable. And then after the data record and the ex-dividend date, meaning ex-dividend date is the date you won't receive the dividend, reverse out the dividends payable and take it out of cash. Very straightforward. So now we look at stock dividends. Stock dividends are what you do when you don't have the cash to pay. A lot of your startup companies might do that, and by incentivizing or trying to keep people to hold their stock, if they don't have the cash, they'll just take retained earnings. Of course, that's the assumption that they've got retained earnings. They'll capitalize retained earnings. Well, I have it in red there. You debit retained earnings and credit common stock is the end result. Okay, so let's look at that. The only part that's complicated about this is GAAP says there's a level, and that level is 20 to 25%. If you're above 20 to 25%, that's considered a large dividend. If it's below 20 to 25%, it's considered a small dividend. Well, what's the difference? The calculations are similar, except if it's a large dividend, you're going to use par value for the stock dividend. If it's below that, you're going to use market value of the stock. That's the only difference. All right, so in this particular case, they declared a stock dividend of 195,000 shares. Whatever percentage that is, it looks like it's a large dividend. I'm not sure. I guess it'll tell us here. So I don't have to calculate it. That may be small. 195,000 shares. All right, it's 15%. So this is a small dividend. 195 divided by 1.3 million. Remember, 1.3 million is not 1,345,000 or 2 million. It's 1.3 million is eligible for dividend, even a stock dividend. So 15% of 1.3 million is 195,000 shares. All right, so 195,000 shares. Then the question is, what dollar value? Because this is a stock dividend. What dollar value are we going to reduce retained earnings to make this happen? Well, we're going to use $15 per share, which is the market price, the market value of the stock. It's what it's trading hands for in the open market right now. So 15 times 195 is your 2.925 million. Common stock dividend distributable. Now, what's that? It sounds like a payable. It's not a payable because we're not paying cash. We're distributing stock. So these are all equity accounts. Common stock dividend distributable, CSDD. Common stock dividend distributable, 195,000 because that's at par. Everything else gets grouped into the additional paid-in capital common. All right, and then when it's distributed, what's going to happen? Because that's when it's declared, when it's actually distributed, not paid, but when it's distributed, we take it out of CSDD, zero that out, and then put it to common stock at par, right? And you can see all of these transactions are in your equity account. Nothing changes. Assets don't change, liabilities don't change, like they do with cash dividends. But with stock dividends, nothing changes. You're capitalizing retained earnings. All right, what if it's a large stock dividend? In this case, 30% stock dividend. All right, what's different? Well, you're still debiting dividends, right? That's like saying retained earnings, dividends, retained earnings, 390,000. Common stock dividend distributable because since it's a large stock dividend, 30%, it's above that 20 to 25% level, then we want to use the par value. It's conservatism principle. That's why we're using the par value on a large. Market value on a small stock dividend, less than 20 to 25%. So here, all of it goes to common stock dividend distributable. You don't see any additional paid-in capital because if it's at par, there's not. So there's at the date of declaration, and then at the date of distribution, we just zero out CSDD and put it to common stock par. All right. FASB doesn't specify an exact percentage on this cutoff of 20 to 25%. Give you room for judgment of what you think is sufficient. Of course, you've got to be consistent in how you do this from period to period, but you are given a lot of leeway there. We're going to look at prior period adjustments as well in chapter, I can't remember if it's chapter 20 or 21, but one of those. So, but we do cover it here as well. What happens with a prior period adjustment is when potentially if you have an error that is material, meaning significant, you got to go back and change prior period. Well, revenues and expenses have been zeroed out to retain earnings. That's where you lost the identity of that. You have to go against retained earnings for that period or periods, right? In some cases, you don't have to go back to prior period adjustment. If it's a change in estimate, like you change depreciation method or change depreciation salvage value or service period, in those cases, you don't make a prior period adjustment. You change it in the current period and forward. If you have a change in accounting principle, yes, you would have a prior period adjustment and retain earnings. But we will look at that in much more detail in chapter 20 or 21, be on the final exam. I'm not sure how much is here. Let's see. Here we've got, didn't record a $50,000 sale on both its books and tax return. That's an error, right? Understated sales and accounts receivable, never collected a receivable, seeking payment from the customer. This is 3 years later. Wow. Tax rate. So what's that look like? Because this has got to be a prior period adjustment. It's a material error. What that looks like, I've got $50,000 receivable from this customer that never told me that I didn't bill them. And retained earnings is the net of tax. And by the way, since I've got more income, I owe the IRS $20,000 income tax payable. That's a prior period adjustment. All right, OCI. Other comprehensive income. We'll look at this in the next chapter as well. Unrealized gains and losses from what's called available for sale investment securities. Sounds like something complicated, but it's not. Available for sale. If you have these securities classified as trading and you have gains and losses, that goes to your income statement. But if it's called available for sale, we'll talk more about that in the next chapter. If it's available for sale, meaning I may sell it, I may not, this investment, then I'm going to keep it on my balance sheet as either a gain or a loss. Holding gain. And really, again, this is unrealized. You're recognizing the gain or loss, but it's a holding gain or loss, meaning I haven't actually sold it. It's a change in the market value. This is something that's just come about in the last several years. Mark to market. Foreign currency translation is another one. We won't get into any of that detail. Unrecognized pension costs and benefits, we won't look at that. The primary area for OCI in this class is the first one there. Unrealized gains and losses from available for sale. Disclosures for stockholders' equity, there's a lot of them. It's like in any area. In fact, the disclosures usually tell you more about a company than reading their financial statements. All right, and finally here, what are some of the key ratios? Well, earnings per share is a key ratio, right? Net income minus preferred dividends divided by common shares, weighted average common shares outstanding. What's the PE ratio? Well, that's the market price of the stock divided by the earnings per share. That gives you a multiple. The lower the multiple, the more undervalued the stock is. Typically, but sometimes you can be like a Netflix and have a PE of 200 and people keep buying the stock. They're anticipating even greater earnings in the future. It's not based on the past. And then you got companies like a General Motors or Ford, their PE ratio is less than 10. The S&P 500 typically is around 25 right now, which is at all-time highs. But PE ratio drives the stock market, and that's what is based on primarily earnings per share. And then return on common stockholders' equity, very similar to number one. It's the same numerator, net income minus preferred dividends divided by the average common shareholders outstanding, dollars. Dollars divided by dollars gives you a return, a percentage, right? Number one is dollars divided by shares is going to give you a dollar amount. The number three is a percentage. And of course, you always carve out all the preferred from your denominator and the preferred payout in your numerator. All right, so that is chapter 15, lecture. Very briefly went through that in about 35 minutes. I would encourage you to read the text, look at these PowerPoints again, and proceed to the homework. And when you're looking at that homework, of course, I've got a homework video that you can view as well to help to walk you through that. But if you have questions, since this is online, please email me. And I'm pretty good about getting back rather quickly, even on weekends. So good luck, and we'll talk again soon when we look at the homework for chapter 15.